Welcome to the Deep Dive, where we take your sources, articles, and insights and help you cut through the noise to truly understand what's important. Today, we're doing a deep dive into the Q1 FYE26 earnings analysis for ARM Holdings PolicySecs. Our mission is to go beyond the headlines, helping you understand the underlying drivers of performance, the company's financial health, and management's forward-looking outlook. We're breaking down a comprehensive earnings analysis report. It integrates ARM's official data with real-time market insights, and it paints, well, a complex picture. You've got strong operational momentum running headfirst into Wall Street's sky-high expectations, and that led to a very immediate and sharp reaction from investors.
Yeah, it's fascinating because, while the official press release gives you the raw numbers, truly understanding them requires putting them into context. And that's exactly what this structured five-part framework in our source material aims to be for us today, guiding us through ARM's performance step by step.
Okay, let's jump in. Now for slide 1, the at-a-glance scorecard.
So looking at the surface, this quarter presented quite a mixed bag for ARM. They actually delivered their second highest quarterly revenue ever, driven by a powerful surge in their high-margin royalty business. But what was the market's initial take on these numbers? Didn't seem quite enough for Wall Street.
No, it wasn't. The report shows ARM reported total revenue of about $1.05 billion. That was a narrow miss against Wall Street's consensus estimate of roughly $1.06 billion. So, yeah, less than a 1% difference, really quite small.
Okay.
However, on the earnings per share front, their non-GAAP diluted EPS of $0.35 was right in line with expectations. Spot on.
Right.
The GAAP diluted EPS, though, came in much lower at $0.12.
And the market reaction was immediate and sharp. That 8.56% drop in after-hours trading,
Right.
that's not a small move. What exactly triggered that?
Oh, yeah, it was stark. Really immediate reaction, plunging 8.56% in after hours. Initial analyst commentaries, as our report highlights, was quite mixed. They acknowledged the impressive growth in that strategically important royalty segment, which we'll get into.
Exactly. But the concern stemmed primarily from that slight revenue miss and critically forward guidance that simply didn't meet the market's already elevated expectations. It really felt like the stock was priced for absolute perfection. Any slip-up was going to hurt.
One aspect that truly stands out in the report is this critical divergence. Total revenue grew a healthy 12% year over year, but their GAAP net income plummeted by a staggering 41.7%. Now, for many listeners, that might scream red flag, big time. How does our source explain this? Is it truly not a sign of deeper operational issues?
Yeah, that sounds alarming, doesn't it? But this is where the profitability paradox, as the report calls it, comes into play. It's a key theme we'll explore. This disconnect is almost entirely attributable to a massive increase in non-cash share-based compensation expenses, SBC.
Okay.
So it isn't really a sign of the core business faltering, but it does reveal a significant ongoing cost for shareholders that's often, let's say, masked by the headline non-GAAP figures.
Right. The non-GAAP looks good, but the GAAP.
Exactly. And the market's sharp negative reaction to such a tiny revenue miss while meeting profit targets really does suggest, like I said, investor sentiment was priced for perfection. This initial response seems to have overlooked the much more significant story of accelerating high-quality royalty revenue. So there's maybe a potential disconnect between short-term market feeling and the company's long-term fundamental progress.
And just quickly, you mentioned diluted EPS earlier. Can you clarify why that's the focus usually?
Sure. So when we talk about diluted EPS, that's basically a more conservative way of looking at per-share earnings. It assumes all potential shares that could be issued, think stock options, restricted stock units, are actually out there. It gives a fuller picture of the potential impact on existing shareholders, the potential dilution, which is why investors typically focus on it over basic EPS.
Got it. Okay. Moving to slide 2, the engine of profitability. This section really highlights what you just mentioned, showing these two distinct stories about ARM's profitability gap versus non-GAAP. It sounds like there's a significant difference driven by how they compensate employees. Maybe quickly define GAAP and non-GAAP again in this context.
Absolutely. So think of GAAP, generally accepted accounting principles, as the company's official, highly regulated financial report card. It's the standard comprehensive view required for filings.
Okay.
Non-GAAP, on the other hand, gives us a kind of cleaner view of their ongoing core operations. It strips out certain one-time or non-cash items like acquisition costs or, importantly here, share-based compensation. This lets us see the underlying business performance without those sometimes volatile elements.
And on that non-GAAP basis, ARM looks very strong.
Exceptionally profitable, yes. The company reported a non-GAAP gross margin of nearly 98%, almost perfect. and a robust non-GAAP operating margin of over 39%. These figures really underscore the immense profitability inherent in its IP licensing model. I mean, the cost to deliver its product, essentially a design blueprint, is incredibly minimal once developed.
But then the GAAP figures tell a much different and frankly more modest story. A GAAP operating margin of just under 11%. That's a huge gap between 11% and 39%. What's making up that huge adjustment?
You're right to point out that gap. It's substantial. To get from a GAAP operating income of $114 million to that non-GAAP operating income of $412 million, ARM added back a significant $295 million in adjustment.
Wow.
And the vast majority of this, the lion's share, consisted of $241 million in that share-based compensation, SBC, and another $54 million in related employer taxes.
$241 million in one quarter for SBC.
Exactly. And while non-GAAP metrics are useful for comparing underlying business performance period over period, you really cannot ignore the sheer scale of this $241 million SBC adjustment at ARM. This represents a real economic cost to existing shareholders. It's equity dilution.
Right. It's like printing new shares to pay people.
Precisely. It reduces the value, potentially, of each existing share over time. And this sheer size is the primary reason for that dramatic year-over-year decline in GAAP net income. It's a critical nuance completely masked by the headline non-GAAP EPS figure everyone focuses on.
So that really highlights the paradox.
It truly does. ARM's profitability is a function of both its high-margin business model and its compensation strategy. While the IP model generates extremely high gross margins, the overall GAAP profitability is heavily impacted by the significant R&D and personnel costs paid partly in stock required to maintain its technological leadership. That's the profitability paradox.
Okay, that makes sense. Next, we delve into Slide 3, the engine room business segment performance. This section takes us right into the heart of ARM's operations. It reveals its two main segments. Licensing and royalties are moving at, well, completely different speeds, and it seems to point towards a successful strategic shift.
That's spot on. The royalty revenue segment was the quarter's absolute standout performer. It surged a remarkable 25% year over year to $585 million. Huge growth.
25%, wow.
Yeah. And this revenue, which ARM earns each time a partner ships a chip containing its technology, is really the financial proof of ARM's strategic success lately. The company explicitly attributes this powerful growth to increasing adoption of its latest higher-value ARM v9 architecture.
The new stuff.
The new, more valuable stuff, exactly. Also, the ramp-up of chips based on its pre-integrated compute subsystems, or CSS, and its expanding footprint in high-growth areas like data centers and AI.
So this royalty revenue is now a much bigger piece of the pie, over half of total revenue now. What about the other segment, license and other revenue? How did that do?
That segment, which represents the upfront fees for licensing ARM's IP for future chip designs, was effectively flat, actually declined about 1% year over year to $468 million.
Okay, so flat.
Management noted this reflects, and I quote, normal fluctuations in the timing and size of multiple high-value license agreements. Licensing can be lumpy, big deals land in different quarters.
Right, timing issues.
Exactly. And while license revenue is still important as a leading indicator of future royalty streams, that 25% growth in royalties is truly the most important signal from this quarter's results. It powerfully demonstrates that ARM's strategy to move up the value chain, sell more complex and valuable IP, and expand into these high-growth markets like cloud and auto. It's not just a narrative anymore. It's reality flowing through to the financials.
And market share gains back that up.
They do. Consider this. The report states the company's market share in cloud compute has more than doubled from just 9% back in fiscal 2022 to an estimated 20% in fiscal 2025. That's significant penetration.
Huge jump.
And similarly, its share in automotive has grown from 36% to 44% over the same period. The success of ARM v9 and CSS, which command higher royalty rates per chip, proves the company has genuine pricing power. They're capturing more value. Combine that trend with the long-tail nature of royalties, where the report notes about half of current royalty revenue comes from products launched over a decade ago, it really underscores the durability and compounding power of ARM's business model. It's sticky.
That longevity is impressive. Okay, let's move on to Slide 4, financial strength and shareholder rewards. Looking at ARM's balance sheet and cash flow, it seems to reveal a company with a strong financial foundation, generating significant cash. How are they deploying that cash? What are they doing with it?
Well, they ended the quarter with a very healthy cash and cash equivalents balance of nearly $2 billion, specifically $1.956 billion. That provides substantial operational flexibility, a nice cushion.
Good amount of cash.
But the most impressive metric here, I think, was the dramatic turnaround in cash generation from operations. ARM generated $332 million in net cash from operating activities this quarter.
Compared to...
Compared to using $290 million in operations in the same quarter last year. So a massive swing from negative to positive.
Wow, that's a huge reversal.
It really is. And it clearly demonstrates that the underlying business's ability to generate cash is far stronger than the GAAP income statement, with that big net income drop, might initially suggest.
So why that dramatic turnaround in cash flow? What specifically contributed to going from burning cash operationally to generating hundreds of millions?
Well, a big part of it is adding back those large non-cash expenses we talked about, like the $241 million in share-based compensation.
Right, it doesn't actually cost cash now.
Exactly. And another $60 million in depreciation. Those get added back to net income when calculating operating cash flow. Plus, there were favorable changes in working capital. Things like collecting cash from customers potentially before revenue is fully recognized under accounting rules. That also boosted cash inflow significantly this quarter.
Okay, and what about free cash flow?
On a non-GAAP basis, free cash flow, which is a key measure of cash available after capital expenditures, like building stuff or buying equipment, was $150 million. That's another substantial improvement from a $348 million cash burn in the prior year quarter. So positive free cash flow generation now.
And how are they using that cash? Reinvesting, returning to shareholders.
Okay. The cash flow statement shows a clear focus on reinvestment right now. The company deployed $154 million for purchases of property and equipment and another $355 million for purchases of short-term investments, likely parking cash safely while earning some return. So at this stage in its public life, relatively soon after the IPO, ARM is clearly prioritizing using its capital to support its aggressive R&D roadmap and expand its tech-led.
Makes sense.
Rather than returning capital to shareholders through dividends or buybacks. The press release provided no information on those, which suggests they aren't a priority right now. It's all about funding growth.
All right. Finally, we arrive at slide 5, the road ahead management's outlook and key takeaways. So pulling all this together with management's forward guidance, what's the overall picture for ARM moving forward? Sounds like maybe strengthening core, capitalizing on AI, but valuation still demands perfection.
That really is the essence of it. That sums it up well. For the second quarter of fiscal 2026, so the upcoming quarter, ARM provided guidance for revenue in a range of $1.01 billion to $1.11 billion. Now, the midpoint of that, $1.06 billion, is essentially flat with the current quarter's results. And crucially, it's slightly below the consensus expectations that the company just missed for Q1.
So guiding below the number they just missed, that probably didn't help sentiment.
Likely not. It probably weighed heavily on investor sentiment in that after-hours reaction.
Yeah.
Their non-GAAP diluted EPS guidance is a range of $0.29 to 37 cents. The midpoint there, 33 cents, is actually below the $35 reported in Q1.
Lower profit guidance, too.
Yeah, which suggests maybe a potential increase in operating expenses coming up, perhaps more R&D spending, or maybe a less favorable revenue mix in the next quarter.
Okay, so despite that somewhat cautious near-term guidance, what's management's longer-term view? Are they still bullish on the AI opportunity, especially with all the hype?
Oh, absolutely. Management's qualitative commentary, the words they use, remains unequivocally bullish on the long-term opportunity. CEO Renee Haas explicitly stated, and I'm quoting here, ARM is powering AI workloads everywhere, demonstrating the strength of ARM as the AI platform of choice from the cloud to the smallest edge devices. Strong words.
Pretty clear statement.
Very clear. And this confidence isn't just talk, it seems backed by tangible progress mentioned in the report. The company is forecasting its market share with top cloud providers will approach 50% in 2025. That's a huge target.
50%, wow.
And they're highlighting that its high-value compute subsystems, the CSS license adoption, is actually ahead of plan. So they see a clear path for continued expansion, even if new-term guidance is conservative.
And our source report offers 3 key takeaways to kind of distill everything we've just discussed, right? These are the main nuggets for you, the listener.
Yes, these really summarize the quarter's narrative quite well. First, what the report calls strong core, soft surface. The quarter's most important signal, really, was that 25% surge in high-margin royalty revenue. That powerfully proves ARM's strategy in AI, cloud, and auto is delivering tangible financial results. Real money.
Hmm.
But this underlying strength was unfortunately obscured, at least initially, by that fractional top-line miss and the conservative near-term guidance, which triggered that disproportionately negative market reaction we saw.
Okay, takeaway one. What's two?
Second, the profitability paradox. ARM is indeed highly profitable from a core operational or non-GAAP perspective, boasting that impressive 39.1% operating margin. Looks fantastic there. However, investors must remain vigilant about the massive $241 million quarterly cost of share-based compensation. That's what caused GAAP net income to fall 41.7%, and it represents a significant and ongoing source of shareholder dilution. You have to watch both numbers.
Got it. And the third takeaway.
And finally, the AI growth engine is real. The narrative of ARM as a key enabler of the AI revolution is now clearly supported by its financial results. It's not just hype anymore. The acceleration in royalties, driven by those undeniable market share gains in data centers and the rapid adoption of its premium CSS designs, confirms that its energy-efficient architecture is foundational to the industry's expansion into AI.
So ultimately, this deep dive really shows that ARM's first quarter results mark a pivotal moment. Their long-term strategy started to yield significant financial rewards, especially in that explosive royalty business. But this operational success story truly collided head-on with the unforgiving short-term expectations of a market that had priced the stock for, well, flawless execution and spectacular upside.
Exactly, a clash between fundamental progress and sky-high expectations.
So for you, the learner, this raises an important question to think about. In a world where immediate market reactions can be so severe based on tiny misses, how do you, as an informed observer, balance a company's clear long-term strategic progress and underlying business strength against the short-term, often emotional expectations baked into the market price? It's a fascinating challenge to consider. Food for thought. This has been another deep dive. We hope you found this structured analysis valuable for building a deeper understanding. Please note, this is for informational purposes only and does not constitute financial, investment, legal, or tax advice. All investment decisions should be made based on your own research and in consultation with a qualified financial professional. Also, please be aware that this deep dive was generated by an artificial intelligence model. It integrates data directly from the company's official earnings press release with publicly available market data. All information, including financial data and calculations, should be independently verified by you before making any decisions. Like and subscribe to StockAnalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.